Hello and welcome to Portfolio Matters, week 177 weekly markets checklist, the final one of the year. Merry Christmas to you all. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
Thank you, Richard. It's a packed week this week because most countries have reported essentially all their macro data over the past couple of weeks. So it's going to be a busy week of data. We're going to push through it because Donald Trump's coming in January and everything could change. So there's only the data as it is of only limited interest as a forecaster of what is going to happen in 2025. Okay, what happened over the past couple of weeks? The Fed cut by 25 basis points, which signaled that it now expects US inflation to be more persistent than previously. And the dot plot indicated that FOMC members only expected to cut twice in 2025, as opposed to 4 times previously. Global bond yields rose and equities fell. The US agreed a last-minute deal to raise the debt ceiling on Friday and so averted an end-of-year government shutdown, but indications that governance in the US is likely to be fraught in the coming few years under Donald Trump. The Bank of England held rates at 4.75% and warned that inflation was likely to rise above 3% in the spring, and that could have a knock-on effect on expectations. It's expecting to keep rates higher for longer. Gilt yields rose to levels last seen after Liz Truss's mini budget. Global markets are charging a huge premium to lend to the UK, unfortunately. The ECB cut rates by 25 basis points as expected, and the EU economy is not doing well. We'll take you through the data. The Swiss National Bank also cut rates by an enormous 50 basis points from 1% to 0.5%. France has a new prime minister, but frankly, I don't think he's going to last very long either. And finally, Donald Trump has threatened the EU with tariffs unless it buys more US oil and gas. And it seems that his threat of tariffs is very much a negotiating tactic. So this is US rates, and they tick down again to 4.5%, a range of 4.5 to 4.75%. But the Fed has warned that the path of interest rates from here is like to be slower cuts than previously expected. And after those comments, there was a sharp drop in the S&P 500. Gilt yields rose, volatility rose. And this is the move in market expectations. Previously, it was expected that the US would end 2025 with interest rates at about 3.4%. The market is now expecting 3.9%, i.e. only 2 cuts rather than 4. But you'll notice that long-term, hardly any change. And although the Fed has been cutting rates, what matters to the US economy is real rates in the as charged to consumers and businesses, and the 30-year and longer term rates have been rising even as the Fed has been cutting. Turning to Europe, this is the ECB interest rates, and they are cutting. The deposit rate is now 3%, main financing rate 3.15%, and given the state of the EU economy and subdued inflation, they're likely to keep cutting. And markets are expecting them to cut rates to below 2% by the end of 2025. The Swiss National Bank halved its interest rate from 1% to 0.5% on concerns about the rising Swiss franc and the poor economic conditions in its main trading partner, the Eurozone. So, apart from the UK, everywhere is cutting interest rates. Now, this is interesting. This is currency markets, and none of them are pricing in tariffs by Donald Trump. The market is not expecting anything in the form of Donald Trump fulfilling his election pledges. Political chaos in France has meant that the yield on French bonds now matches or surpasses those of Greece. So the markets have gained confidence in Greece and lost confidence in France. And finally, the Omni bubble continues. Fartcoin briefly passed a market cap of 1 billion, is now only 820 million. And finally, Saudi Arabia will host the 2034 World Cup. Money buys everything in the modern world. Okay, on to this week's economic data. Quick summary, right? In the UK, we have clear signs the private sector is slowing. It was slowing even before the budget, and the budget has had a very clear effect on confidence, knocking it hard. So it seems the private sector is going back into recession, but Rachel Reeves will be increasing spending on the public sector. Will that offset it? In the EU economy is weakening once again. US looks just fine. China weak, but possibly improving according to the PMIs. Onto the UK, Richard.
Thank you, Keith. UK interest rates, Keith has just said, flat at 4.75. UK GDP growth in the final quarter was 0. UK GDP growth year on year for quarter 3, 0.9%, which is worse than expected. And UK CPI month on month, 0.1%, as expectations. Year on year CPI 2.6%, which again is with expectations.
So month on month, inflation looked pretty subdued, but of course there's a strong seasonal effect.
Yeah. Core CPI month on month, 0%, 0 in November.
The trouble for the UK is that even though we've got weak numbers now, we have this big chunk of inflation coming through, and hopefully January numbers will again be negative. If they're not, then this big negative number from January last year, due to the fall in energy prices, will mean an inevitable rise in UK inflation in January.
Very true. So UK core CPI year on year 3.5%, which is too high, and RPI month on month 0.1%, year on year 3.7%, again too high.
3.6% actually, slightly below expectations.
Yeah. So CPIH is now overshooting CPI substantially, which means that housing costs are increasing.
Yeah. So this is quite interesting because, you know, in 2030, index-linked gilts moved from RPI to CPIH.
Yeah.
Well, actually, right now, CPIH is matching RPI, but long-term, CPIH matches CPI, which is about 1% below RPI. And during the pandemic or post-pandemic, it was undershooting CPI, but it's now overshooting CPI because of the lagged effect of housing.
And so saying rental inflation is now catching up with house price inflation, and UK rents and house price annual inflation both up last month.
Yeah, this really squeezes renters and young people.
Although our inflation is similar to that in other countries, our bond yields are substantially higher. And
borrowing too much.
Yeah, borrowing too much, exactly. With an expectation we're going to be borrowing more and a stagnant economy. Service inflation at 5%, and goods inflation has just gone back positive after 7 months of a negative value.
Yeah.
So a lot of moving upwards in inflation at the moment, isn't there? Not that much moving down.
Yeah. Well,
The Bank of England expects inflation to rise to about 2.75% in the second half of 2025.
Yeah.
Before falling towards its target of 2% in the second half of next year.
Yeah. Despite that, in the MPC meeting, 3 of the 9 members voted to cut, citing weakening employment markets.
Yeah.
So the MPC clearly thinks that the slowing economy will bring inflation down, but the historic data will be a big drag, basically forcing inflation up over the coming months.
Yeah. So UK input PPI was 0 in November, and year on year it's down 1.9% in November. And output PPI 0.3% in November and 0.6%, minus 0.6% year on year. So those figures. UK earnings growth, including bonuses, 5.2%, which is higher than expected.
I was absolutely shocked by these numbers. The bond market took this really badly.
Yeah.
And the biggest component was actually from the manufacturing sector. Manufacturing wages rose 6%. And we know that we've been shedding lots of manufacturing jobs in the UK. So it's strange.
Yeah. Yeah. I mean, it's not, in some sense, it's not surprising, is it? If you look, I mean, is it rent is something like, for young people, it's something like 50% of their disposable income.
Yeah.
So rents have gone up by 10%, just rough numbers. Then they need a 5% increase in their disposable income simply to keep up with their rent payments.
Yeah. But the thing is, it's set by wages are set by the market, Richard. And you're seeing that falling demand for people, for workers, that should bring wage growth down. Now, I think what's happening is a lot of mandated wage growth. If you say that the minimum wage goes up by 7%, then if you hire a lot of young people, then your wage bill is going to go up by 7%.
Yeah, very true, Keith. So UK earnings growth, excluding bonuses year on year, is 5.2% in October. So we have earnings growth which is significantly higher than appears consistent with the target rate of 2%.
Yeah, and going in the wrong direction.
Yeah, and a lot higher actually. So
yeah, I agree.
And pay growth, including bonuses, 5.4% for the private sector, 4.9% for the public sector. So actually not that much difference between the two. And manufacturing sector saw the highest pay growth, despite the fact that it is shrinking.
Yeah, and so it's a survey, and when I saw this, I just wondered whether they are oversampling big companies and undersampling small companies, because I can't imagine small companies are raising wages very much at all. The economy is struggling.
Yeah, particularly, I mean, it is October, just pre-budget probably.
Yeah.
Pre-budget, I mean, about.
Yeah, let's see.
Yeah, and so strong private sector earnings growth is as says at the side, this is the falling jobs, falling job vacancies. Yeah, we've got high earnings growth, and our slowdown looks a bit sharper than it has been elsewhere. And we've gone from there's a change in job postings. We've gone from a lower peak, and we're now a lower low. So we're not performing very well.
We're not. Yeah, since the pandemic, jobs growth terrible.
Given that in 2020 on that graph, everybody started off at the same point. Declining job vacancies in leisure sector suggests falling consumer demand. And the interesting thing here is that the leisure sector is one of the hardest hit by Rachel Reeves' tax increases.
Yeah.
And this is the UK unemployment rate, which is on a sort of noisy upward trend.
Yeah, and it's from the labour force survey, which you know is very poor quality. So, how much to believe, frankly.
Yeah. So the UK 3-month employment change is 173,000 increase.
Yeah. Again, from the labour force survey, I'm just not sure whether I believe this because it's
No,
showing really strong surge in job growth
I'm not sure
in
I believe it
August.
either, Keith. Completely. UK claimant count was effectively unchanged in November. And HMRC payrolls in November suggested that 35,000 people, fewer people were employed.
Yeah, but again, last month it said the first data was -5 and then it's
Yeah,
revised up to +24. Now, I just don't know why they don't report it with a lag because it's always changes.
yeah.
But again, this does not seem compatible with growth of what was it? 350,000 people as of
No,
August.
no, it doesn't, does it? UK GDP month on month, October down 0.1%. So I think we can actually say we've probably got some form of stagflation now. We've got
Yeah.
growth and we've got inflation is too high.
Yep, agreed.
GDP year on year was 1.3% in October. So
Yeah.
worse than expected and frankly, not very good at all. And all sectors of the UK economy contracted in October. And that was before the effects of the budget. So everybody is struggling. High energy prices, severe consequences for those energy intensive industries. So you can see the cumulative change in output for the chemical industry has been about -35% since the
Mm,
invasion of Ukraine. UK retail sales month on month were up 0.2% in November, and year on year in November up 0.5%. So the retail sector doesn't look particularly healthy.
yeah, not going anywhere. All below expectations.
Yeah. Industrial production month on month was almost 1% below expectations, down. Year on year was almost 1% below expectations and down. Construction output was down.
Yeah, I'm surprised by this actually, because confidence in the construction sector has been rising, and Rachel
Mm,
Reeves has been promising a big investment in infrastructure.
yeah. UK car production year on year is down 30% in October.
Yeah, terrible, really terrible.
And manufacturing PMI is 47.3 in November, below expectations and continuing to fall.
Yeah, that's a bad trend.
Services PMI was actually above expectations and above 50.
But remember, services, the average PMI is well above 50.
Yeah.
So that's not a great number. It's not disastrous, but it's not great.
And the composite PMI is at 50.5. And so the PMI employment sub-index fell quite sharply, very sharply actually, looking at this chart, to 46 from 49. So that's a big drop. So probably as a result of the national insurance rises in the budget, plus the
Yeah.
minimum wage rises expected that people don't want to take on. New orders fell sharply,
Yep.
and flash PMI input costs by sector, service input prices rising, and manufacturing input prices rising percentage-wise even more.
Yeah. So that's increase in wages.
Which is suggesting that inflationary pressures will increase, are
Mm.
increasing, have
Are
increased.
increasing, yeah. Absolutely.
So the UK GDP tracker suggests November is at 0.
Yeah.
All of this GDP data is looking very depressing. So the industrial trends new orders are -40 in December, very significantly below expectations. And that chart, that compared to pre-COVID, it looks decidedly unwell.
Yeah. And really sharp drop post budget.
Yeah. CBI distributive trends again down significantly and more than expectations in December. And again, this chart looks unhealthy. The consumer confidence index, the UK, down at -17 for December, although it has risen substantially from where it was a few
Mm.
months ago.
Yeah.
But still, not great. House prices going up again.
I'm amazed by this, absolutely astonished, because we've actually had, when we go through the bond yields on UK 2-year and 5-year bonds have risen about 1% over the past 3 months.
Yeah,
And most mortgages are 2 or 5-year. So the cost of mortgage has shot up.
yeah. Yeah, agreed. UK balance of trade was minus 19 billion in October, and
Mm.
it is not good. UK trade balance down minus 3.5 billion in October, same as September. And again, our trade balance looks very poor.
It does.
PSBR excluding banks, it's looking horrible.
Yeah, but it was actually better than expected, he says.
Yeah.
For how long?
And the economic surprise index is down at the depths.
Well, the thing is, it's actually bounced a bit, which surprises me, Richard, given everything we've gone through, all the data falling. It's presumably people have adjusted their expectations down to,
So they're
and
not so surprised when we
yeah,
get bad data.
exactly. That's right.
The job postings index is down again from
Yeah,
continuing down.
15% below pre-COVID levels.
Yeah. The budget is imposing fiscal restraint on departmental spending from 2027 onwards. So no pain yet.
Yes, exactly. Yeah. And the question is, will they actually follow through with any of this? It's easy to promise the austerity later.
And the Institute of Directors Economic Confidence Index is at the lows last seen at the mini budget, and actually last seen effectively at the start of the first lockdown.
Yeah. But this is an absolutely shocking number. 2016 is well below that.
And interestingly, you can just if you go from where the interest rates rise to over 5%, at which point it started to rise reasonably comfortably up until the point of the new government.
Yes, that's right.
When they started to trash talk the economy.
Well, and then they followed through with very business unfriendly policies.
Yes. So KPMG, the report is showing a sharp decline in employment. So permanent placements and temporary billings indices, sharp decline in November 2024.
Yep.
UK Christmas hiring sluggish compared to previous years.
Yeah.
Very sluggish.
Basically, everything is adding up to the UK economy being weak and weakening. And in particular, post-budget confidence has taken a huge knock, and that hasn't really started to come through in the data yet.
And I think we've also got we still have the impact of the huge, in percentage terms, the huge interest rate increases that we had a couple of years ago, and people's mortgages coming off their previous fixes and having to be fixed at a much higher rate. That must still be coming through. And we've always said, haven't we, that there's a very long tail to that policy.
Yeah, and also, Richard, when we're talking about London rents increasing by 12% over the course of the last year, that essentially is another tax on young people and renters. So that will reduce their disposable income, etc., etc.
Yeah, so Bank of England surveyed employers and how they would react to rises in NI increases in the budget, and 54% expected to raise prices and 54% expected lower employment. And since 2010, health spending has grown, but all other departments have been cut. It's quite interesting, isn't it?
Yeah.
So, which is why it feels that nothing is working, because they've got to the point where they've become dysfunctional.
Yep. No, nothing works in this country anymore. Justice system in particular is terrible.
I mean, the problem is that governments, and well, I have to start off, I'm afraid, start with David Cameron, but they have totally neglected the economic health and put in, and the consequence of that is that we simply can't afford what we would like to have. Long-term decline. So depressing, Keith. Can we move on?
It doesn't get better, Richard.
Storm Dara has destroyed a new 50 megawatt solar farm in Anglesey. Gosh, look at that.
Yeah, not good, huh? More on clean energy later.
So I can summarize by saying this really, um,
It's
it's,
grim.
it's grim. Yeah.
It's a grim end to the year. Now, the good news is the Independent Pay Commission has recommended a public sector pay rise of 2.8% next year. Expect strikes from the unions, but wage inflation should come down. And
Yeah.
with it, that inflation should come down. But it will be a rocky path. And we've got bad comparators from last year, which means that inflation is sure to rise above 3% in the coming months. And what I am particularly worried about actually is what Rachel Reeves does next, because the OBR, all their forecasts, they gave her very little wriggle room against her own fiscal rules. And the UK economy is now weakening, which means tax revenue is going to fall and benefit payments going to rise. And that will mean that she's on track to miss her own fiscal targets, which means she either has to raise taxes, which she said she won't do until next October, cut spending further, or abandon her fiscal rules
But if
and
she
borrow even more.
and
Guess which one she'd probably do?
if she raises tax, she'll just drive the economy further into a hole.
Yes, but that hasn't stopped her so far, Richard.
And maybe she's beginning to understand the consequences of her actions, Keith.
Well, you would like her to actually take on the unions and reform the NHS and just because basically from the chart we showed earlier, the NHS is consuming all the resources of the country, and we need to restrict it in some way. Right, onto the EU. On that cheery note, is the EU doing any better? We ask ourselves. Answer no. So the ECB cut rates to 3.15%, and that's on a steady downward track. Industrial production was actually slightly better than expectations in October, flat. Not a great result, but better than September. Year on year, minus 1.2%. But is that bottoming out? Wage growth, too high, 4.4%, but at least coming down, unlike the UK. Manufacturing PMI, dead as a dodo, terrible number, 45.2. Services PMI actually bounced back in November, 51.4, better than expectations. Composite stuck in recession. Consumer confidence for December weakened, and the economic surprise index was actually surprisingly better than expected at plus 2.2, a big change on previous week. Although you'll notice they've revised the entire series. So Richard's point about this being not much use at all. We'll move swiftly on. The German Indeed job postings index seems to have bottomed out, which is surprising. The French index keeps on falling. And the German, this is the business climate index. That is a really, really bad trend. Germany looks to be in deep trouble. And new orders minus inventories, that is hitting new lows. That's awful. That is a really awful chart. And this is real industrial production, and the black line is energy intensive industries, down 30% since 2006. Shocking, really shocking. So closing those nuclear power stations has just had a disastrous effect on the economy, just madness. Meanwhile, in France, manufacturing PMI hit the lowest level since the pandemic. Not good. Hiring intentions are collapsing. But good news is the disastrous economy will bring inflation under control. And frankly, if you look at the 3-month annualized numbers, inflation is already under control, already at the 2% target. So, in summary, the core of the Eurozone, France and Germany, looks structurally weak and weakening further. As a result, the inflation outlook is benign. But it looks to me like the EU is heading back to its pre-COVID trend of low growth, low inflation, and low productivity. Expect the ECB to keep cutting rates. And frankly, on that, from all the data we've seen, expect the ECB to cut rates back to stimulative, i.e., below R star and below 2, because the Eurozone economy is doing nout. On to the US, Richard.
Thank you, Keith. So US interest rates cut in December, as we know. There's a lot of discussion about what the interest rate cutting cycle is going to look like in the US.
Yeah.
And they may be slowing down the rate of interest cuts. But
yeah, it is on a downward path. Question is, how quickly?
US GDP growth now at 3.1% in quarter three, ahead of expectations.
Yeah, revised up. Yeah, contrast with the UK. 0 in the UK.
And quarter on quarter annualized 3.1%. Corporate profits quarter on quarter annualized down 0.4%, but
yeah, isn't
high.
this surprising though? Isn't
Yeah.
that surprising? Yeah. Actually, the national accounts showing that corporate profits, you can manipulate earnings per share as much as you like, but that clearly looks like a topping out. Or, well, actually, well, take it back. That looks like earnings growth has been minimal over the past 4 quarters.
Yes. US PCE prices quarter on quarter at 1.5% in quarter three. So continuing to fall, in fact.
Yeah. In Q3, not much inflation.
Yeah. And quarter on quarter annualized 2.2%, which is pretty much where the Fed wants to be.
Yep. So the worries are resurgent inflation in the US.
CPI month on month 0.3 meeting expectations. Year on year CPI 2.7%, again meeting expectations.
But slightly up on October.
And higher than their target. Core CPI month on month 0.3%. That's been stable for the last 4 months.
Yeah, and stable at too high a level.
Yeah. So year on year it's 3.3%. As Keith says, stable at too high a level. CPI shelter is coming down, and CPI ex shelter is not coming down.
Yes.
And sticky inflation does appear to be sticky. And
yeah, it's coming down, but it's coming down really slowly. And
non-seasonally adjusted core CPI was virtually 0, as opposed to 0.25% for the headline figure. So there is no resurgence in US inflation that we can see.
Yeah, but so what it's saying is that core CPI this month, was too high because of the seasonal adjustment. But that will mean that, in some other months, it will be adjusted down in a way it shouldn't have been.
Yeah.
So, it'll all come out in the wash, but not to get carried away by one, bad number.
Yeah. So CPI shelter is continuing to print much higher than market rent indices because there's lag effect. So that has the effect of keeping inflation appearing higher than it actually is. And if you calculate inflation using real-time market rent data, then inflation has fallen to below the Fed target.
Yeah. So everywhere, like the UK, housing has shot up since the pandemic and is not coming down despite much higher interest rates. It's amazing.
So core services ex shelter is still at 4.1%. And wages are continuing, the rate of increase in wages is continuing to fall quite sharply.
So, this illustrates the difference between the UK and the US. The US is having GDP growth of 3.1%, and it's got wage growth that's lower than ours.
Yeah.
That is how to run an economy.
We've got wage growth with no GDP growth.
Yeah. We've got pure stagflation.
PCE month on month, 0.1%.
Yeah. Now, this is important actually because PCE inflation is the Fed's preferred measure and it has a much lower weighting for shelter.
Yeah,
So it's showing inflation is much lower.
year on year, it's at 2.4%. Core PCE month on month, 0.1%, and year on year, that's at 2.8%.
Yeah. So better numbers than CPI.
Yeah. PPI month on month was 0.4%, and it was revised up in October. PPI year on year is 3% in November, again revised up in October as well.
Frankly, that is not a happy chart.
No.
That suggests inflation is coming back.
PPI, core PPI month on month, 0.2%. Core PPI year on year, 3.4%, which is quite high, and also revised up last month.
Yeah.
Personal income month on month, 0.3% increase in November. Personal spending month on month, 0.4% increase in November. UK retail sales month on month, 0.7% up in November, better than expected. And year on year, retail sales up 3.8%, which has met expectations. Industrial production month on month, down 0.1% in November, and year on year, down 0.9% in November. Manufacturing PMI is 48.3, worse than expected. And services PMI 58.5 was better.
Amazing. That
Yeah.
is a fantastic number, huge number. So real increase in service sector confidence post-Trump election. Reminder, there's very little correlation between the PMIs and actual economic activity, though.
Yeah. So the composite PMI clearly reflecting the strong services.
Yeah, that's wrong. I'll correct that as well.
So the business optimism index in November was 101.1, which is significantly better than expectations, and a real lift
Yeah.
upwards in the month.
Huge jump.
Yeah. According to the National Federation of Independent Businesses, current sales are still poor, but they're optimistic that Trump will fix everything. And we all are.
Mm.
So the US small business optimism, 9 out of the 10 components index were up. Rachel Reeves is just sitting at her desk thinking, if only.
Well,
US Conference Board leading index is at 0.3 in November, so it's better than
yeah.
expected.
The first tick up in 2 years.
Yeah. And stronger building permits and higher stock prices boosted the leading economic indexes in
Yep.
November. US building permits up at 1.5 million in November, again, better than expected.
Amazing.
Looking healthy. Housing starts at 1.29 million, mildly below expectations, but still strong. Existing home sales look like they might be getting themselves up off the floor, actually.
Yeah, but I think this is lagging. And the reminder that interest rates in the US have shot up. 30-year mortgage rates have really risen over the past month. So let's see what happens in the coming months.
Yeah. Initial jobless claims of 220,000, worse than expected. I mean, we have to view the jobless claims as being really very dodgy with the huge revisions that they've been making for the last 12 months. Continuing jobless claims, 1.8 million.
Yeah, but not surging higher.
Jobs postings index appears to be pretty much leveling out now.
Yep.
Link Up, however, is continuing to report rapidly declining job openings in the US. So a bit of contradictory data there.
It is. It's amazing. That's showing really clear deterioration in job openings, job postings.
Okay, so the Dallas Weekly Economic GDP estimate is at 2.7%. The Atlanta GDP now for quarter four is 3.1%. New York Fed nowcast GDP 1.9%.
Yeah, I like this one the best.
And the St. Louis Fed at 1.5%. The Citigroup Economic Surprise Index, I don't know, not sure. The US Trueflation, 3%.
Yeah, this kind of I think this rather reflects reality actually.
Yeah.
Inflation has come back as the got a big boost to disinflation from falling energy prices that now is at an end.
And credit is cheap by historic standards,
Yeah,
and markets are currently expecting low level of corporate bankruptcies. But the fiscal deficit in the US is pretty much out of control. And as the
yeah,
net interest expenditure percent of tax revenue is currently at 15% and projected in this to rise to 25%
yeah,
over the next 10 years or so. But as we can see, we know that the US deficit is just getting bigger and bigger. And the
yeah,
first 2 months of this year, it is bigger than ever. So increase in business optimism since Trump's elected, not reflected by an increase in loan demand. Summary, we've got PPI is moving in the wrong direction. And there's a bit of contradictory data on inflation, but it doesn't look like it's problematic at the moment. Sales, income, spending will remain strong. Wage inflation is falling. Services PMI have surged. And the bottom line is the economy remains strong at the moment.
yeah. Thanks, Richard. On to China. Okay, so Chinese house prices continuing to fall, been falling for a while now. Industrial production came in slightly better than expected in November at 5.4%. Decent number. Retail sales, though, not great. Well below expectations. The Chinese economy is not rebalancing away from investment into consumer demand. Fixed asset investment continues to decline. New yuan loan growth way below expectations. And social financing, which is how much money the Chinese government pumps into the economy, is again well below expectations. M2 growing up 7.1%, that seems a decent rate, but outstanding loan growth continuing to decline, declining again in November against expectations of a rise. Balance of trade continues strong, above expectations, rising. Export growth, though, beginning to slow. Import growth, actually terrible, and that is a bad chart. I'll fix it. And the bond market does not believe that the Chinese economy is recovering. It's fallen to new lows and below those of Japan. But nowcasts of the Chinese economy suggests it has had a bit of a bounce. Watch this space. And the government is stimulating the economy through an increased fiscal deficit, the highest in many years. But housing starts continue to fall. And historically, over the last 30 years, the Chinese economy has been propped up by investment in the property sector. And that big prop to the economy continues to weaken. And this is new floor space started clearly new lows. Well, lower than 2023 and much lower than the range of the last 20 years. So the Chinese economy looks to be stuck in a balance sheet depression, as we've discussed many times, despite a recent uplift in PMIs and the nowcast. And the bond market is signaling the Chinese economy remains weak. We believe the bond market. Okay, onto one chart. The red line here is total debt, and the green line is GDP. And the point is that debt is rising much faster than GDP. So one way of looking at that is that how much of an increase in the deficit is required to buy a dollar of nominal GDP growth. And that rate is rising. So the fiscal multiplier in the US is deteriorating. They keep on increasing the size of the deficit, but it's buying less and less increase in the economy. So they need to rein in that. They're not getting bang for your buck, basically, in terms of increasing the deficit. You need to rein it in, and it will have less of an effect on GDP growth. Richard, this is interesting, I think.
So this year, India surpassed China as the most populous nation on Earth at 1.4 billion.
Yeah, but
Gosh.
China is like also what, just over 1.4 billion.
Yeah. China's leveled off, hasn't it? And it's actually started to fall slightly, whereas India is still rising.
Yeah.
And China's fertility rate below 2% in the early 1990s. 1%, gosh. So one in
Yeah.
2023.
Yeah. Now, reminder, China had this one-child policy between 1979 and 2015. So the question is, how are those numbers compatible? It fell below replacement rate in 1990, but its population, sorry,
Oh, they're
its
dodgy in the
population,
numbers, isn't there?
yeah, the two numbers are incompatible.
A chat GTP model for the Chinese and Indian populations based on reported fertility numbers predicts the Indian population correctly, but says the Chinese population should be 890 million. And it's officially, as we've just seen, at 1.4. So 1.4 billion. So what's going on?
Well, that's it, Richard. What is going on? They're either misrepresenting their population numbers or their fertility numbers, but the two can't be correct. And I would bet they're misrepresenting their population numbers to make themselves look bigger.
So is that why one of the reasons why they have too many empty properties? Because officials have been allowing residential property to be built at a rate to accommodate a 50% inflated population.
It could well be. Yeah.
That doesn't exist.
Yeah. But if this has big implications.
Yeah, it does. It does indeed, doesn't it? So what are the implications? So maintaining of GDP growth clearly will be very difficult. Excess production capacity in the economy.
Yep.
Service inflation because of lack of labour. Potentially low investment, low interest rates.
We're seeing very low interest rates collapsing in a way that is perfectly compatible with demographic decline.
Yeah, it's exporting its excess goods production, which keeps global goods inflation down. The property market won't be able to recover. Why is that? Why is the last point the case, Keith?
So last 20 years, last 30 years, we've had a very low inflation because essentially we've integrated an enormous Chinese workforce into the world economy.
Yeah.
And although China is communist, it's an incredibly capitalist economic system and incredibly efficient in a way that, let's say, India is not. And so we've outsourced a hell of a lot of our manufacturing to China, and its growing population, but certainly moving from the countryside to the city and coming into the global economy. Well, that process is at an end. There are no more Chinese workers to stick into the world economy.
Depends also. So it depends what happens to Chinese productivity as well, doesn't it?
Yeah. Well, actually, it should increase because, they've got fewer workers.
Yeah, it'll have to increase if they want to maintain the same levels of output.
Yeah.
But of course, presumably though, they've also been doing the output. They have been managing it on that already lower level of population. So therefore, the fact that we've discovered it, if we have discovered it,
yeah. Well, the thing is, Richard, but I come back to your point about whether they've been planning for 1.4 billion, because if the officials say they're 1.4 billion, you're kind of minor officially, you're not going to say, oh well, actually I think the number's 900 million. You're going to say, yes boss, I will build for an extra 10 million apartments. Okay, onto the UK economy. And actually the UK economy is sick, long-term sick, but this is about the population. So, contrary to the previous narrative about the lingering effects of long COVID, etc., etc., the number of people who are surveyed and who declare themselves to be long-term sick, economically inactive, has actually gone back to pre-COVID levels. It's only the labour force survey that shows people declaring themselves long-term economically sick. When you actually look at their health, They're not sick. Something's going on. So this is the labour force survey and the response rate. And you can see basically nobody's answering the labour force survey. As that is a shocking number, 18%,
Yes.
you know. So this previous result is a result of only the people who want to give you their opinion of how badly they're doing, replying to the labour force survey. This chart, which shows people who are declaring themselves long-term sick, you know, it seemed to be that the UK was a real outlier, and our population's health had deteriorated much more than the rest of the world, frankly. But again, this are people who are declaring themselves economically inactive due to long-term illness. When you look at the surveys just focusing on health, you don't get that response. And there is a very strong correlation between the people who are claiming incapacity benefits and the people who are saying that they're inactive for health reasons. Now, the causality could run both way rounds, but the number of people on incapacity benefit is a function of the attractiveness of incapacity benefit relative to unemployment benefits, not genuine illness. So, when the attractiveness of incapacity benefits rises and falls, so people declaring themselves to be unhealthy enough to get it also rises and falls. So in the 1980s, the Restart program made unemployment benefits less attractive, causing people who are on long-term unemployment benefit to switch to invalidity benefit. So more people claimed incapacity benefit. In the 1990s, the government responded to rising incapacity benefits by making medical screening more stringent. The rise in caseloads came to an end. Then in 2008, the switch to employment and support allowance saw existing claimants reassessed under stricter criteria, and the number of claimants with incapacity benefits fell again. But in the last 5 years, we've introduced universal credit and online assessment. That's quite important instead of assessment in person, and that has led to many more people claiming generous health-related incapacity benefits.
So, Keith, what you don't understand here is that the online assessment is much cheaper to do.
Exactly. That's precisely right, Richard. So it's again a great example of the UK shooting itself in both feet.
And I have to say, of the Tory government's gross incompetence,
Yeah,
I am so cross with them. Everything they touched, they ruined.
yeah, I agree. We complain about the Labour government, but the Tory government, they couldn't continue. So here you go. Health problems down here, incapacity benefits up 40%. You know, that is all a function of the benefit system. So the Labour government is throwing money at everything rather than actually dealing with structural issues and reform. If it wants to get the fiscal deficit under control, it needs to do some hard work of actually reforming the benefits system and reforming the NHS. Let's see whether they actually do it. Recently, I've had a comment on a video I did 2 years ago, which was predicting that US corporate profits would start to fall in 2023 because of the Kalecki-Levy equation. Now, let's go through this again. And what does it say about 2025? So, I was predicting back in 2022 that S&P earnings would fall back towards trend. In fact, they didn't. They kept on rising, and actually they're now 25% above trend. So what is the Kalecki-Levy equation? Well, I'm going to go through this quite quickly because hopefully you will remember. If not, go back and watch the video. But it arose because two independent economists were trying to work out where profits came from. And the Kalecki-Levy formula says that financial profits equal the government budget balance, the household balance, and the current account balance, which all should sum to zero. So what you need to know is when the government increases its fiscal deficit, corporate profits rise. When the households increase their savings, then corporate profits fall. And an increase in the current account balance positively increases financial profits. So, business investment. Well, when a company invests $1,000, it's paying that $1,000 to other companies. So, the total profits of the business sector as a whole increase by $1,000. So, business investment equals corporate profits. Dividends. When a company pays a dividend, it's not an expense. It is instead a distribution of profits to shareholders, but then the shareholders use that money to buy goods and services, i.e., that money flows to other businesses. So profits equals dividends plus investments. Government spending. If the government runs a balanced budget, i.e., expenditure equals taxes, then corporate revenues from government expenditure equals taxes. So aggregate profits equals zero. So profits only increase when the government runs a deficit. So profits equaled investment plus dividends plus government deficits. Then household savings. When households save, they take money out of the economy. They reduce spending in the corporate sector. Therefore, profits equals investments plus dividends plus government deficits minus household savings. And finally, the external sector. If consumers are spending money on foreign goods, then they're subtracting it from the corporate sector, the domestic corporate sector. So the full Kalecki-Levy formula equals profits equals investments plus dividends plus government balance plus household balance plus the current account balance. So why does this matter? Well, back in 2022, there was a huge surge in the fiscal deficit, and I was saying that as the fiscal deficit fell again, so that would mean corporate profits normalized, and so the huge surge in corporate profits we'd seen would fall back again. But of course, it hasn't. It's kept going. So what did I get wrong? Well, actually, what I completely missed, of course, was the fact that although the budget ballooned, so did the savings rate. And so most of that money was not spent. The US government gave US consumers lots of transfer payments, and they didn't spend them immediately. They spent them in the coming 2 years. So that meant the big surge in government expenditure in the fiscal deficit did not come at once. It came over the last couple of years. And then, of course, Joe Biden increased the fiscal deficit again, supporting US corporate profits. But now the fiscal deficit is expected to shrink in 2025, even before Elon Musk's Department of Government Efficiency gets going and attempts to cut $2 trillion from the US federal budget. However, as we've seen, in the first 2 months of the year, the fiscal deficit actually increased, and the University of Michigan is forecasting that actually the fiscal deficit will expand again in 2025 and then again in 2026. First 2 months of the year compared to previous years are really shocking. The Biden administration has completely lost control of the US federal budget. So where does that leave us? Well, the surge in US corporate profits, if the Trump does manage to rein in the US fiscal deficit, then the growth in the fiscal deficit should slow or go negative, and that has negative implications for US corporate earnings. Reminder that the market is expecting US corporate earnings to grow by 20% next year. Now, if the Kalecki-Levy model is correct, we know that the US savings rate is currently very low, so that can't fall much further. And the US deficit is very high, and that can't increase much. And also, Donald Trump has committed to try and get it down. All of that has negative implications for the outlook for US corporate profits, according to the Kalecki-Levy formula. Richard, any thoughts?
Interesting, isn't it, Keith? I mean, we sort of know instinctively that if you increase the government deficit, that money has to come out somewhere, and clearly it's coming out as you've described it. My thought is that the US is in this extraordinary position where it can do this.
Yes.
So, it's the only country in the world, I think, that can actually operate this system of enormous deficits and not crash its currency or its economy. And it's part of a really complex international position at the moment, isn't it? Where with the enormous privilege of having a US dollar and the world's reserve currency, the BRICS countries wanting to move away from it. Is the deficit sustainable? I agree that I think Elon Musk may succeed in cutting the government deficit to an extent over a few years. It's not going to happen in February.
Yeah. The bottom line for me, Richard, is that the huge surge in US corporate profits is the reciprocal of the huge rise in the US fiscal deficit, which is unsustainable. So to me, it's like US corporate profits are unsustainable. And even if the US continues running this deficit, in order to keep growing US corporate profits, they'd have to keep on increasing the deficit, which they can't do. So at some stage, there has to be a slowdown. Full stop.
So how much does a UK degree cost? As rough calculation, student tuition fees, 9,000 from 2025, 9,000 a year. Maximum student loan for London is 13,000. So the total effectively there is 19,500 or 58,000 for a 3-year degree course. But loans starts to be repaid after you earn over £27,000, which is pretty much the threshold of the new minimum wage, isn't it? Which comes in April.
Yeah, well, minimum wage is 22 grand, but that's not far above it.
No, at a rate of 9%, which is usurious, clearly.
Yeah,
and the interest rate actually varies between RPI and RPI plus 3%, depending on your earnings.
But so the moment you go above £27,000 salary, your tax rate basically jumps by 9%.
Yeah. The UK actually has the most overqualified workforce in the world. 37% of employees believe that they're overqualified, and they earn an average of 18% less than employees who believe they're well qualified for their role. And interesting where the US is there, overqualification rate 26%.
Yeah.
And so we've got overqualification and a very expensive higher education system, and which people are lured into.
Yeah. So, an aside, so I have a nephew who has not gone to university, and he's joined the docks as an apprentice. After 2 years or 3 years, he will exit on a wage of 42 grand.
With no student loan.
No student loan. Yeah. And he'll have earned money for those 3 years. He'll have lived at home. And, compare that with, immediate graduate. They come out with 60 grand's worth of debt, and they go to work in Starbucks.
Yeah. We've got too many universities that don't provide a high standard of education. but it exists basically to keep the academics in those not very good universities in
Yes.
So we need to stop wasting taxpayers' money to allow students to acquire worthless degrees, and we need to tighten up and focus our higher education system so that we produce people with the skills that the economy needs.
Exactly.
And the sort of expansion of the higher education system that occurred really around the time that student loans became the norm for funding?
Yeah. It was Tony Blair, wasn't
Yeah, I mean, one was always suspicious that he did it in order to massage the unemployment numbers.
it?
So anyway, we've got this surfeit of people with qualifications that don't assist them, but they pay a lot of money for.
Yeah. And another aside, actually. So we had the plumber around a couple of weeks ago, and he is quite a young entrepreneur, but must be late 20s. But this time he brought a sidekick, and who he described as his apprentice. It turned out he wasn't his apprentice. It was his mate who had, after university, joined the civil service. And after 2 years with the civil service, he'd hated it and he'd left to join his mate, not as his apprentice, but as, his sidekick. And the plumber was teaching him the ropes.
Yeah.
So, perhaps his system is healing itself, Richard.
Yeah, gradually. So this is about what happens to our electricity prices when there's no wind. So in the week starting 9th of December, there was a high pressure system sitting over Europe, causing wind speeds to plummet. Electricity prices consequently surged across Europe, and day-ahead prices reached 936 euros per megawatt hour in Germany and Denmark. Notice how in northern Norway, if that is Northern Norway, they were 15 euros per megawatt hour.
Yeah, actually €7.
Oh God, they have a lot of hydroelectric power, but that's extraordinary.
Yeah. Yeah, 2 men and a reindeer there, and lots of hydropower.
Yeah, electricity prices in the UK surged up to £3,100 per megawatt hour at the peak, which is just extraordinary. I mean, just need base load, don't we? Base load is what's required. So indicative daily average wholesale electricity prices in the UK, and you can see that enormous peak in December.
Yeah.
And it's very noisy, isn't it, that graph? The German power price rises to the highest in 20 years. And we thought it was high after Russia invaded Ukraine, didn't we?
Okay, so this is the UK grid on Thursday, the 12th of December this year. So demand was about 42 gigawatts, but our 30 gigawatts of wind power, was generating just 1 gigawatt, and solar, because it's winter, was also generating almost nothing. We've also closed all the coal-fired power stations. So look at the red circle, coal 0, unlike in previous years. So in previous years, we could just turned on a coal-fired power station. Now we can't. So what did we do? Well, we turned on gas. Gas surged to 27 gigawatts, nuclear 3.8, hydro 2, biomass, that's chopping down Canadian and American forests, burning them here, that's 2.4. And also our interconnectors were useless because there was no renewable power throughout Europe. So we imported electricity from France, but then we re-exported it to Ireland and Denmark.
Gosh, who designed this system? Oh, politicians.
Mm.
So spot gas prices, however, were 110p per therm, 37 pounds per megawatt hour. So if you do the numbers, then the marginal cost of electricity generation was about £90 per megawatt hour, bearing in mind that we're talking about £3,000 per megawatt hour, the actual sort of output price. So the gas generation is not particularly expensive, even when there's a huge demand for it. So since the UK has no coal-fired, so it has no coal-fired base load, it has that 3.8 megawatts of nuclear base load. and the mothballed gas-fired power stations had to be turned back on to provide the enormous amount of marginal power required. And they are expected to maintain, only occasionally used, and they named their price when they're needed. And they named their price at £3,000 per megawatt hour. And this is a huge fluctuation, which if you imagine, industry will presumably either it shuts down whatever it can when prices spike,
Yeah.
because they will be paying whatever the price is. Hugely damaging for the UK economy. And we just need 15, 20 gigawatts more of base load power.
Yeah. But what our government's doing, Richard, is it's investing in carbon capture and storage, which does nothing except
But
increase costs.
and uses up whatever base load power you've got.
Yeah.
Well, we'll have a chat with Ed Miliband, shall we?
Yeah. Does the chat involve brass knuckles?
We never advocate violence on this show, Keith.
Mm.
So, basically the problem is that we are prostituting the UK economy on the altar, if this is a mixed metaphor, isn't it? On the altar of green energy.
Yeah.
I'm all in favour of green energy, but you have to have a decent amount of base load power.
Yeah.
You haven't got it.
And actually, but whatever you do, if you increase the grid's dependence on renewables, which are intermittent, you're going to have to run two parallel electricity systems and maintain them. So.
And the other problem I think that we should have alluded before is when it is very windy and the wind turbines are operating at maximum capacity, there isn't the capacity to take the power into the grid.
Yeah, I know.
So they have to be deregulated.
Yeah.
Regulated down.
It's a cheery episode this week.
Yeah.
Happy New Year.
Yeah, turn the lights out.
And on to Inflation Watch. So we've had numbers for November everywhere and generally, sadly, up. So this is the delayed effect of the fall in energy prices falling out of the comparator window everywhere. So inflation is going to keep rising in the coming months because energy deflation has stopped. So in the UK, CPI at 2.6%, expected to keep rising to above 3% in the new year. Core way too high at 3.5, RPI 3.6. US 2.7%, core flat at 3.3. Eurozone inflation lower and actually subsiding towards the 2% target. Japan actually had a big jump in inflation at 2.9% in November. China, though, inflation dead as a dodo, 0.2% and falling. This is Japan's inflation rate, and actually Japanese inflation has been above the 2% target for 2.5 years now. So the Bank of Japan actually needs to start getting serious about raising rates. Now, the velocity of money has shot up. And is there any correlation between the velocity of money and inflation, we ask ourselves? But GavCal is forecasting on the back of the increase in the velocity of money that inflation will surge and we'll have a second wave of inflation. It seems there's no evidence of that, frankly. It seems to be a lot of weight to be putting on just one indicator, which is highly unreliable, as you see from this chart. US M2 has been rising for the last 16 months. Will inflation follow? Good news though, rental inflation in the US continues to fall, unlike in the UK. This is UK inflation, where UK inflation actually undershot the Bank of England's forecasts over much of 2024, but is now going to surge again and will overshoot them because wage inflation has not come down. And a large part of the fact that the government has mandated big rises in the minimum wage, and we have mandated stagflation. If we want to get inflation under control, the government is going to have to stop increasing prices. Now, the FT has got a core inflation calculation, which is the outcome of a regression model of various underlying measures to find the best predictor of long-term trends. So make of that what you will. They won't say what they're actually doing, but the pink line is FT core inflation. In the US, that looks stable and a bit too high, frankly. In the Eurozone, coming down towards target, but blipped up a bit. UK, actually a downward trend. And when you look at the UK data and the FT's core measure on the 3-month view, is quite difficult to get any good news out of UK inflation at the moment, actually. But 3-month annualized FT core is slowing, is falling. And that contrasts with the headline core. So that potentially is good news. And they're saying that that means the Bank of England should get some good news in the spring. When I look at the US, then again, FT core is lower than core, but it's still high, still much higher than target. So in summary, the last mile in returning inflation to target is proving the most difficult, but inflation is coming down slowly. The path from here is likely to be rocky with the noise extrapolated in both directions. On to recession watch, Richard.
Thank you, Keith. So the Walmart indicator, which is relative performance of Walmart versus S&P luxury index, showing the US consumer struggling. And it's consistent with a coming recession. As we have discussed, the markets aren't pricing this risk in, but the indicator actually looking quite stretched, isn't it there, Keith?
Yeah, absolutely. And there's an article in the FT today talking about the slowdown in luxury goods inflation,
Right.
the expenditure, and saying that that means that people are pulling in their horns.
Yeah. US new job postings on Indeed fell 38% year on year, now below pre-pandemic levels. And US wholesale sales down over the past 2 years in real terms, which doesn't seem compatible with a strong US economy.
Yeah.
Nor high corporate profits.
Yeah.
Capital goods orders have been falling ever since interest rates rose. And actually, the interesting thing there is all the interest rates flattened out some time ago. Capital goods orders have continued to fall. And historic correlations holding in the US would imply that unemployment should begin to rise in 2025 as the jobs hard to get, less jobs plentiful.
Yeah, absolutely. But we've been saying this for a very long time now.
Yeah.
And that has been true for a while.
This is the graph of the income needed to buy a house versus median income. We could see this enormous disparity there between the two.
Yeah.
And income needed to buy a median house in the US has doubled in the last 4 years, which is a huge inflation rate.
Yeah.
It's like 15-17% per annum, whatever it works out at.
Yeah, and that is why CPI is elevated.
Yeah.
Because of housing, owner's equivalent rent is feeding through.
Got a K-shaped recovery in the US. Low-income Americans continuing to struggle, and you can say the same for the UK, actually, I believe.
Yeah.
Job openings continue to decline, and the hiring rate is low. I mean, I think you could probably say the same thing for the whole of the Western economies.
Yeah. Okay, on to other charts. Thank you, Richard. So this is robo-taxi trips in California. And you'll notice they're all Waymo, not Tesla. Tesla share price has gone through the roof on the back of, prospects for robo-taxis. But actually, Waymo is the only one with cars actually in operation, and it's increasing really rapidly. So that is 1 year It's gone from 30,000, well, actually probably less than that, 10,000 to over 300,000 trips. So does that mean the days of the Uber driver are coming to an end? Is it all going to be robo-taxis? That potentially is a big surge in unemployment.
I'd like to know what the parameters are within which robo-taxis are allowed to operate in California. So
Yeah.
routes they can follow and so forth, and typically what they're used for.
Various Discord members have taken robo-taxis and say they're absolutely fine. And this is the currencies used in international payments. And you'll see that everyone's been talking about the decline of the dollar, but in world trade, yeah, it's Europe. Nobody's using the euro.
So what's the consequence of that, Keith?
Well, basically, the exorbitant privilege of the dollar continues. This is interesting. This is programming job postings on Indeed in the US. So I was talking with my son about his future career prospects. I said, don't go into software because
Yeah.
AI could take over. And, that is not good. So 30% less job postings than pre-pandemic. And after the disastrous performance of the UK economy, we need some good news. And I thought this was very funny, actually. So thank you to our Discord member Magnets for saying this. So this is a great example of what happens when how high taxes can distort consumer behavior. So what we've got here is somebody who has lost a lot of money in the US posting a marriage advert for anyone, male or female, who's got some profits they want to offset. So the idea is they'll get married. He has capital losses that he's looking to offset against someone with capital gains. And then they'll split the tax savings and get divorced again in a few months. And I particularly like the slight preference for females, but open to males as well.
He just wants to use his tax losses up.
Exactly. So basically, this is a great example of how, if you tax too highly, people's activity becomes concentrated on avoiding tax rather than on production.
Yeah.
So anyway, second piece of good news this week. So
do you think we should send a link to this to Rachel?
Yeah. Well, I don't think you'd get through, mate. So this is from Simon W. Thank you very much. And this is power generation in the US. And you see, bottom right here, the share of US power generation that is not fossil fuel, we'll put it that way, has been rising. And I particularly like how nuclear is included in clean energy, so not fossil fuel, which frankly is true. And something that Germany and the UK should very much take on board. But essentially what they're doing is they're switching out of coal into gas. And solar is growing, but it's still tiny. Wind is growing, but it's still, again, not very big. But, the switch from coal into natural gas is reducing the CO2 intensity of the power system. And onto equities. Richard.
Thanks, Keith. So a fairly gloomy week in general for equities last week, although not a bad year for them. So a lot of the markets down 3%-ish, and Russell 2000 was down 7%. This is obviously after the Fed's commentary on interest rates and inflation. Hang Seng was actually up 0.3%, Topic's down 0.3%. Bitcoin had a bad week, down 3.6%. And the pound and the euro, so basically the dollar is behaving very strongly, and so the pound and euro are both down against the dollar, and the VIX surged by 43%. So this is the FTSE All World Equity Index.
Good year, up 16%.
Yep. The FTSE All Share only up
Okay.
4.5% for the year, down 3% for the week.
Yeah.
The Euro Stoxx 600, very similar, down 3.6% for the week, but up 5% for the year.
Yeah, but in both cases, interest rates have shot up, and the economies are not doing well, and they're slowing.
Yeah, and the only thing that's keeping them afloat is increasing government debt.
Yeah.
S&P 500 up 25% for the year. Bit of a bad week, as we said, but
Yeah.
who cares really? The Nasdaq up 30% for the year, a little bit down on the week. The Russell 2000 only up 10% for the year and down 7% for the week. And the Hang Seng pretty much unchanged on the week, but up 16.5% for the year. Topics up 15% for the year, and again, not really changed much on the week. Bitcoin is up 124% for the year. The pound down 1.3% both the week and the year. And the euro down nearly 6% actually against the dollar for the year. The dollar index, as you can see, it's had a really strong run up from basically Donald Trump's election.
Well, the US economy is the only one doing well.
And the VIX spiked hard and has now fallen back.
Yeah.
So the 4%, the drop in the S&P does not look significant in the context of the trend.
Yeah.
But the participation in the rally is continuing to get narrower. And foreign holdings of US equities continuing to rise. This is that rise, big rise at the end, is actually over about 15 years. So it's a gradual but continuous increase. S&P growth earnings growth outlook is 17%. This is expectations, of course.
Yeah.
As we've discussed, and I think that really interestingly, the expectation is based upon continuing increasing government debt. Fundamentally.
Yeah.
History suggests that you should not buy the S&P 500 when growth expectations are high, because your future returns will be worse. And we've discussed it actually probably about the last couple of years, haven't we, Keith? And of course, so far, future returns have been jolly good.
Yeah, they have.
Fund manager allocations to US equities at an all-time high of 36% overweight. And no one wants to bet against this stock market. So bearish bets have dropped hugely. So, and who blames you really? Because dividend yield on the S&P 500 is falling. It's now 1.2%, as bond yields are rising. Bond yields near 5%-ish.
Well, in the US, 4.7, 30 yen.
Very big difference. And buying the S&P 500 at all-time high has been, contrary to the chart that we showed previously, has been a very successful investment strategy in the recent past. Market corrections are relatively rare. So it just shows you that 1 year out from all-time high, the chance is 9%. 3 years, 2%, 5 years, doesn't really happen. The history of the Fed cutting when the S&P is at an all-time high suggests that this time, in a year's time, the market will be higher than it is now. Retail investors are the most optimistic that they have ever been. Now, the trouble with all of this stuff is everything that happens before a crash, seriously.
Yes, exactly. That's right.
The market cap of Magnificent Seven as a share of the total index is now 33%. Did you say, Keith, that the Tesla market cap is half of the market cap of all vehicle manufacturers in the world globally?
Like this, yeah.
Yeah.
Yeah. It's absurd. And meanwhile, price of electric vehicles aren't selling and resale value of Tesla's collapsed, so.
Apple's PE ratio has risen to nearly 42%, sorry, nearly 42. And Berkshire Hathaway has sold nearly 70% of its stake.
Its revenues growth has collapsed, yet its PE ratio has gone through the roof. I don't understand.
AI, Keith.
Yeah.
And the omni bubble, the rapid proliferation of cryptocurrencies, highlights a virtually unlimited potential supply.
Yeah.
The illusion of Bitcoin's so-called scarcity. So 80% of Bitcoin is owned by a few individuals.
Yeah.
So if you buy Bitcoin, you are in fact enriching a few individuals.
Okay, thank you, Richard. On to commodities and generally weak. So energy mixed, oil is up, EU natural gas was down, US natural gas actually up 20%. Industrial metals and precious metals generally weak. So turning to energy, Brent was up 2.7%, bouncing back from weakness in the previous couple of weeks. WTI up 3.4%, both are down on the year. Good news is that European and UK natural gas faded, although still up big on the year on fears of supply disruptions when the Russian agreement to supply gas through Ukraine comes to an end over the winter. Meanwhile, US natural gas futures surged by 20% over the past couple of weeks and are up almost 60% on the year. Coal continues to decline, as does uranium. Uranium down 20% on the year. So this is Brent really, frankly, hitting a bottom, going nowhere. WTI the same. Numbers specific to the oil market. Well, actually, we're still getting inventory drawdowns in the US. So total inventories in the US increased by 30 million barrels over the course of the year, but recently they've been falling again. US crude production continues to rise and has hit a new all-time high at 13.6 million barrels a day. And that's despite a falling rig count over the course of the year. Amazing. The shale revolution is a technology revolution, and productivity just keeps on rising. Now, reminder, the IEA is forecasting an oil market that will be in surplus throughout 2025. So oil prices unlikely to be rising. And that's before OPEC opens the taps, if they do. So these are EU natural gas futures. That's not great. Implies that gas prices will be higher for consumers. You can see the path of inflation. Big drops in energy prices led to energy deflation, and since then been rising again. Same in the UK. US natural gas futures surging. It's winter. Coal falling. Very interesting. So the US energy mix is switching from coal to gas. And looking at coal, global coal production has hit yet another peak in 2023. Most of that is in China. China's burning a hell of a lot of coal. And if you look at the energy sources, but this in percentages, you'll see that coal use has fallen, but it still remains very high. It's, almost entirely fossil fuel. Add that up. 77% fossil fuels. So renewables have been growing very quickly, but they're still a tiny part of the overall mix. UK is doing very well. Rest of the world, much less so. Moving on, uranium bull market, I'm afraid, is fading, down 5% on the week, down 20% on the year. On to industrial metals, Richard.
Keith, so industrial metals pretty much falling across the board last week. Aluminium down 2.5%, cobalt unchanged, copper down 2.4%, chromium unchanged, iron ore down 0.3%, lithium down 1.2%, neodymium down 3.5%, nickel down 4%, tin down 1.6%, and zinc down 3%. And actually quite a mixed bag for the year as well, with iron and lithium being the biggest fallers at 27 and 21%. Cobalt was down 16% for the year. Nickel down 7%. And the only ones that rose are aluminium, copper, tin, and zinc.
Yeah.
So quite a mixed bag. So there's aluminium, cobalt, copper.
Yeah, towards its lows for the year.
Yeah.
Dr. Copper diagnosing a weak world of manufacturing sector.
Yeah. Chromium, iron ore, lithium, and neodymium. Nickel.
That's not a happy looking chart.
No, it's not. And tin. Zinc. Precious metals. So it wasn't a very good week for precious metals. Gold down 0.6%, but up 28% for the year. Silver down 4, nearly 5%, but up 23% for the year. Platinum and rhodium pretty much unchanged, and palladium down 6% or 24% for the year. There's gold. It hasn't really gone anywhere for the last couple of months.
My daughter, who's started work, has been living at home and saving lots of money. She's put all her savings into gold.
Is she?
Yeah.
Very sensible girl. China is increasing its gold reserves, and I think what China actually does and what China says it does are different.
Yeah.
It's probably been increasing its gold reserves much more quickly than this chart suggests, but it's
Yeah.
the hours of work to buy 1 ounce of gold got increased from 10 in 1968 to 80.
Yeah. But it's quite a this peaks and troughs.
Yeah. Silver, we have the silver chart, platinum, rhodium, palladium. Doesn't seem to be loved by anyone.
No, it doesn't. Onto rates. Thank you, Richard. Okay, so absolutely shockingly terrible couple of weeks for me. But the UK yield curve shifted up yet again. So you see the blue line is last year. You've had an absolutely enormous rise in the 30-year 1%. So from over 4 to over 5% in the course of the last year, and the same in the US. Long rates rising over the course of the year. And everyone hates bonds. So sentiment towards US bonds is right down at the bottoms. Terrible. And US bonds yield much more than the Nasdaq. So Nasdaq used to yield more, and now bonds are more attractive. But that does not mean the bond yields are going to fall. And people will buy bonds. So this is the UK 2-year, and you'll see it's had an absolutely enormous rise from 3.6% to 4.4%. It's up again this morning. So that's that. If you're a mortgage holder in the UK and you need to refinance, your mortgage costs will have risen by 80 basis points. That's 25% over the course of the last 3 months if you need to refinance. So the thing is, rise in yields in the UK does have big consequences. You've had significant monetary tightening, and the economy is already slowing. If monetary policy works, and it does, but with a lag, then the UK economy is going to slow further. Now, naturally, wages, prices should fall. But was the course of the last 3 months, the Labour government has instituted mandated price rises, essentially, in wages and national insurance, which feeds through to wages and prices. What's going to happen? If it allows the economy to normalise, then inflation should come right back down. But if they react by mandating further price rises, we've got stagflation. This is the UK 10-year hitting new highs, back up again this morning. Terrible, terrible, terrible for me. So I was break even back here, 3.5% up, 1%. I've got absolutely killed this year. Not funny. Not funny. So that's the 30-year, also terrible, up again today. US 10-year, unlike the UK, not at new highs. The UK, new highs for the year. Despite the fact we have growth of 0 in the last quarter. German bond yields rising despite the fact the German economy is slowing.
The thing about German bond yields is that Germany debt to GDP is something like 40%, I think, isn't it?
Yeah.
So it has, in modern parlance, huge capacity to increase its debt. I don't think it should do. I think it's a really bad policy in the long term.
Yeah.
Obviously, there's a lot of calls for it to do so in Euroland. And so it's sort of, as a comparator, it's not really particularly good to let's say, well, most of the other countries in the Western world, because we're all so much more indebted than Germany is.
Mm. Yeah, absolutely. France, not good. But again, France is in a total mess.
Yeah.
It hasn't got, basically, it's got a very unstable government. Its deficit's much bigger than ours. The economy, as we've seen, is slowing even worse than the UK is. And bond yields are the best part of 2% lower than ours. So, concluding comments. Well, if you invested in the Omni bubble in 2024, you've had a great year. The US economy has been amazingly resilient in 2024, whereas the UK and the EU are clearly slowing. As we go into 2025, Donald Trump enters the office of the White House. Expect volatility. So, how's your year been, Richard?
So my year's been fairly reasonable, Keith. The last few months has the performance hasn't really gone anywhere. Been the it sort of didn't. I guess the precious metals didn't carry through from their climb in the first part of the year up until sort of the autumn. It's not done very much in the last few months. I'm quite comfortable, although the price of uranium has fallen back to the spot market. I'm quite comfortable with my uranium investments because the uranium market is driven by the long-term contract pricing, basically, and the spot price is not so relevant. But obviously, the long-term contract pricing is quite opaque. And also, it's driven by the enrichment, and I've got some shares in uranium enrichment. So, yeah, it's been a bit so-so really over the last couple of months, but generally for the year, it's been reasonable. And I'm not envisaging making any particular changes in early 2025, at least. So yeah, in contrast, I'm sorry to say, Keith, to what you tell us about your performance.
Well, very well done, Richard. Congratulations. It shows your kind of well-balanced and sensible approach to life has absolutely trashed me this year. I have had by far the worst year I've ever had. And I've lost about 20%, roughly. So it's absolutely shockingly bad, particularly when everyone else is making money. I hope all our viewers have had a better year than me. The irony of the situation is, I thought I'd worked out how to play this game, and I was extremely confident that all the indicators were the US would go into recession, and that meant that interest rates would come down, inflation would come down, and it didn't. It kept on going. And the US economy has been incredibly strong. I have, as UK bond yields started to rise, I've tilted more and more into them until I'm hugely long duration, and I have made the decision that in order to get the money back, I would keep my risk levels extremely high. And in the past few weeks, as bonds have sold off, I've got absolutely stuffed. Now, if you put more money into highly volatile assets and they go against you, then you have to live with the consequences. And I absolutely am living with the consequences of that. And but the bottom line is that in order to get the money back, I need to keep the volatility high, essentially. And it's part of the strategy, not much fun. But when I look at where we are, okay, so talking my book, and I've got this totally wrong, and you should all, this comes with huge caveats. But ultimately, the interest rates that can be supported are a function of inflation and productivity. Now, Bank of England has 2% mandate, and if you believe they will meet their mandate medium term, and I think they will, then CPI-H inflation, which will become the relevant measure, should subside towards 2.2%. Let's say it settles about 2.3%. Then real interest rates will function of the productivity of the economy. The UK productivity is absolutely abysmal. It's like it struggles to get to zero currently. It's been negative. So the UK simply can't afford high real interest rates. Now, the 30-year is currently yielding an amazing a terrible 5.1%. So you're getting 2.8% real. Now, that's in the long term after the move to CPIH. Now, if I did not think that was possible, yeah, so one of the reasons I got totally stuffed is I didn't think the move to big positive real interest rates was supportable by this economy. I thought, given the increase in debt, that real interest rates would rapidly kill the economy. That meant inflation would fall back down, interest rates would fall back down. And medium term, I think that's absolutely true. I think that the Bank of England at some stage is going to have to cut interest rates to below R star, i.e. the natural rate of interest, to stimulate the economy, because the UK economy is not growing. It's going absolutely nowhere. And yet we have strongly restrictive interest rates. So at some stage, interest rates have to come down. And what's happened over the last month, where I've got absolutely taken out, is that interest rates have surged higher, despite the fact that all the indications are that the UK economy is slowing further. So,
yeah, I mean, I guess there's a problem, isn't there, in the sense that the Bank of England can set the interest rate at what it likes to, but the market sets the gilt rate.
it does, yeah.
And
Yeah,
if the market is concerned about the affordability of government borrowing, which it
yeah.
is, I think, then the two will tend to bifurcate.
Now, there is a positive to all this, actually, in that what I've done is I bought income. I bought REITs and I bought long-term bonds which pay interest. And so I've sat down, I've worked out what my income is and what my expenditure is. And I have much more income than expenditure. So I am basically I've lost one hell of a lot of money, actually, and it's not much fun, but it's sustainable and I can sit through it. And at some stage, the Bank of England, I think, is going to have to cut rates really hard, actually down to below 2%. Now, that won't happen anytime soon because inflation's too high. And in the meantime, I've got a highly volatile and risky asset that's
Yeah.
price is going to go bananas, left, up and down, and that's going to be very stressful for me. But I just have to sit through it. And at some stage, the Bank of England will cut rates because the UK economy is going nowhere, will slow down. That will bring inflation down if the Labour government lets it. And I should get out of this alive. But not
Well,
much fun.
no, fingers
And
crossed.
frankly, got it totally wrong. Thank you to everyone for your support. But, we just have to call it as it is. It's been a total bloody disaster. So, anyway, on that note, thank you all for continuing to watch, and happy Christmas and a Merry Christmas and a Happy New Year. And we will see you again in the new year. In the meantime, don't drink too much.
Yes.
And
Don't eat too much.
let's
Eat
hope the new
healthy.
year's better than the last.
Yes.
Merry Christmas, and it's goodbye from Richard Wheater.
It's goodbye for Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.